There is a dangerous myth in investing, a myth that has quietly destroyed more fortunes than economic crashes, more than market bubbles, and sometimes more than bad luck itself. It is the belief that somewhere out there exists a single perfect investment, one stock, one asset, one strategy that guarantees success. But what if the real secret to wealth isn't about finding the best investment? What if it's about understanding something far more powerful and far less obvious? Ray Dalio calls it the holy grail of investing. And once you understand it, you will never look at money, risk, or financial security the same way again. Ray Dalio isn't just another financial voice in the crowd. He is the founder of Bridgewater Associates, one of the largest and most influential hedge funds in history. Over decades, his firm navigated inflation shocks, recessions, market booms, and financial collapses while managing billions of dollars for governments, pensions, and institutions. Dalio didn't earn his reputation by chasing hot trends or predicting stock tips. He built it by studying how economies move, how risk behaves, and how most investors unknowingly sabotage themselves. Through decades of data, crashes, recoveries, and experiments, Dalio discovered a pattern that challenged one of the most common assumptions in finance. And it started with a simple but uncomfortable realization. Most investors believe they are diversified, but they aren't. Imagine someone building a house. They use strong bricks, solid wood, expensive materials. Everything looks secure. But underneath the house, the foundation rests on one fragile pillar. It may stand for years, until pressure arrives. Then suddenly, everything collapses. That is exactly how many investment portfolios work. People think owning several stocks means they are safe. They believe spreading money across different companies or industries protects them from loss. But Dalio discovered something shocking. Most assets don't move independently. They rise and fall together. And when a major economic shift happens, portfolios that appear diverse often fail at the exact same time. To understand why, Dalio went deeper than traditional financial analysis. He studied economic environments across decades, inflation periods, recessions, deflation cycles, growth expansions, and monetary shifts. He realized markets are driven by forces larger than individual companies, forces that move entire asset classes simultaneously. These forces can be simplified into 4 economic conditions: rising growth, falling growth, rising inflation, falling inflation. Every economy moves through these cycles repeatedly, and every investment reacts differently depending on which environment dominates. Some assets thrive when growth is strong. Some explode during inflation. Others protect wealth during recession or deflation. But here's the critical insight. No single asset performs well in every environment, and this is where the illusion of investment certainty begins to break. During the late 1990s technology boom, many investors believed they had discovered the future. Tech stocks skyrocketed. Fortunes were built overnight. Confidence spread like wildfire. People believed the trend would never end. Then the dot-com bubble burst. Trillions of dollars disappeared. Companies vanished. Retirement accounts collapsed. And investors who thought they were safe learned a brutal lesson about concentration risk. Years later, the 2008 financial crisis delivered another shock. Investors heavily tied to real estate and financial markets watched their portfolios crumble as housing collapsed and credit systems froze. History kept repeating the same message. Markets change, economic conditions shift, and overconfidence in a single strategy often leads to devastating consequences. Ray Dalio wanted to solve this problem permanently. He wasn't searching for the best stock or the fastest-growing sector. He was searching for a way to design portfolios that could survive uncertainty itself. After decades of testing thousands of portfolio combinations, he uncovered something astonishing. If you combine assets that react differently to economic conditions, you can dramatically reduce overall risk without sacrificing returns. This discovery became what Dalio famously called the holy grail of investing, and the principle behind it is surprisingly simple, yet incredibly powerful. Dalio found that true diversification is not about owning many investments. It's about owning investments that behave differently under different economic scenarios. When one asset struggles, another rises. When one sector crashes, another stabilizes the portfolio. This creates balance, stability, resilience. Dalio's research showed that combining just 15 to 20 truly uncorrelated investments can reduce portfolio risk by nearly 80%, while still maintaining strong long-term returns. Not eliminating risk, but managing it intelligently. And this idea fundamentally changes how wealth is built. To understand how this works, imagine balancing weights on a scale. If all weights sit on one side, the scale tips dramatically with the smallest movement. But if weights are distributed evenly across both sides, movement becomes controlled, stable, predictable. Dalio applies this same concept to investments. He balances portfolios across different asset types such as stocks, bonds, commodities, and inflation-protected securities. Each serves a unique purpose depending on economic conditions. Growth assets like stocks thrive during economic expansion. Bonds often perform well during deflation or economic slowdowns. Commodities and real assets tend to protect wealth during inflation. By combining them strategically, investors create portfolios designed not for perfect prediction, but for survival across uncertainty. But Dalio's strategy goes beyond numbers and charts. It taps into one of the most dangerous enemies in investing: human psychology. Investors naturally chase what is performing well. When markets rise, excitement grows. Confidence turns into overconfidence. Risk is ignored. When markets fall, fear spreads. People panic. They sell at the worst possible moment. Dalio understood that emotional decision-making destroys long-term wealth more consistently than market volatility itself. The Holy Grail strategy creates structure that protects investors from their own impulses. It replaces emotional reactions with disciplined balance. It allows investors to stay invested during chaos and avoid reckless decisions during booms. But perhaps the most powerful lesson Dalio teaches is this: the future is unpredictable. No expert, no economist, no algorithm can consistently predict market direction. Economic systems are complex, constantly shifting, influenced by political decisions, global events, technological change, and human behavior. Trying to guess the next winning investment often becomes a dangerous gamble. Dalio's philosophy shifts the focus from prediction to preparation. Instead of asking, "What will happen next?" he asks, "How do we build portfolios that survive whatever happens next?" This mindset transforms investing from speculation into strategic risk management. It replaces fragile wealth with durable wealth. And it changes how investors measure success, not by chasing explosive gains, but by achieving consistent long-term growth while minimizing catastrophic losses. Because in investing, survival isn't just important, it's everything. An investor who avoids devastating losses gains something far more valuable than quick profits: time. And time allows compounding to perform its quiet, unstoppable magic. Throughout history, financial disasters rarely happen because investors lacked opportunity. They happen because investors ignored risk concentration, trusted short-term success, and believed trends would last forever. Ray Dalio's Holy Grail isn't a secret stock or hidden asset. It's a framework, a way of thinking, a system built around balance, discipline, and acceptance of uncertainty. And perhaps that is the most uncomfortable truth in investing. There is no perfect investment. There is no guaranteed prediction. There is only preparation, diversification, and disciplined patience. Those who chase certainty often lose everything trying to find it. Those who prepare for uncertainty often build wealth that survives generations. Ray Dalio spent a lifetime searching for financial perfection. What he found instead was something far more powerful. Not the elimination of risk, but mastery over it. And in a world driven by unpredictable markets, shifting economies, and emotional investors, that mastery might be the closest thing investing will ever have to a holy grail.